What is value investing? What does it look like in a real portfolio? That's what we're going to be discussing today. And we're going to do it by looking at real companies so you can see not only what to look for, but why. I just need one thing and one thing only from you guys. Please hit that like button for me. Now, before we dive into some real companies, we first need to understand the basics of value investing. So let's draw it out. Value investing is a term first created by Benjamin Graham, who's also known as the father of value investing. It was then preached and made famous by his most successful student, Warren Buffett. So it must be pretty legit, right? The idea is simple. Buy a company when its market value is less than its intrinsic value. Now, most channels would just leave it at that, but I'm going to take this even further, so stay with me. The first step is getting the market value. This is pretty easy. Simply take the current stock price of the company and multiply it by the number of shares outstanding, and you get the market value. Or you could just Google the market cap of the company. It's the exact same thing. Next, we need to figure out the company's intrinsic value. This step is a little bit harder. There are three relatively easy methods that we can use to do this. The first is Benjamin Graham's method. The second is a discount cash flow model. And the third is using the company's book value. Let's apply each of these methods using Micron technology, one of my larger positions in my portfolio. To calculate the intrinsic value of a company using Benjamin Graham's method, we can use this formula. Let me explain these values. EPS is the company's current earnings per share. This can typically be found on any website displaying the current stock price. The 7 is the updated price to earnings ratio for a stagnant company. Back in Benjamin Graham's day, this used to be 8.5, but it's now been revised to 7. G is the expected annual growth rate of the company. Back in Benjamin Graham's day, this used to be 2 times the growth rate, but again, today it's just been updated to G. 4.4 is the historical average yield of AAA corporate bonds. And then Y is the current yield of AAA corporate bonds. You can find this through a simple Google search. So let's plug in some values for Micron. Micron's current EPS is $4.18. We can assume a growth rate of around 15%, and we can assume the current AAA corporate bond yield is right around 5.45%. Plugging these values in, we get a value of $74.24 per share. Compare this to Graham's old method, where we would get a value of $129.92 per share. Note the large difference between these two values. This shows that calculating intrinsic value is more of an art rather than a strict science. Let's now look at the second version, a discount cash flow model. To explain what a discount cash flow is, let me ask you 2 questions. First, would you rather have $1 million today or $1 million 10 years from now? The answer is pretty obvious. We'd all take the $1 million today, right? However, when I ask you the second question, would you rather have $1 million today or $5 million 10 years from now? The answer is a little more nuanced. We know what $1 million is worth today, but what will $5 million be worth in 2035? Would it be more, equal, or even less than $1 million today? That's exactly what a discount cash flow model attempts to answer. In order for this to work, it relies on 3 key business principles. First, the value of a business is proportional to its cash flows. Second, using past performance of this business and standard market environments, we can project the business's cash flow over the next 5 to 10 years. And then third, cash flows in the future are worth less than they are in the present day. This third one is for 2 main reasons. One is inflation, and the second is the fact that the business is not immediately realizing those cash flows, thus making them more risky for an investor. In order to account for the third principle, we need to discount the future cash flows to their estimated value today. By doing this, we can find an answer as to whether or not $5 million in 10 years is worth more than $1 million today. So how do we go about doing this? Thankfully, there are many tools out there that can do this for you. I'm going to be using the discount cash flow calculator from Qualtrim made by Joseph Carlson. This calculator has two options, one for earnings and one for free cash flow. So let's start with earnings. For EPS, we'll enter the current value of $4.18. For the EPS growth rate, we see that their previous growth rate was 99%. Looking at Yahoo Finance, we see a growth rate of over 100% for this quarter and over 50% for the next year. According to Graham, though, it's almost impossible for companies to maintain a growth rate greater than 15% for multiple consecutive years. Using this, we'll put the growth rate at 15%. Next is the appropriate PE ratio. Again, to be conservative, we'll put in a 25 PE, which is relatively low for the tech sector. Lastly, we have our desired return. All this does is show us the price that we need to buy the stock at in order to realize our desired return. Plugging this in, we see that the price in Q1 of 2026 is projected to be just under $110. If we inflate the PE to 35, which is more of a bull case, we get a price of $117 per share. Let's calculate this using free cash flows. The current free cash flow per share of the trailing 12 months is 7.06. Again, we'll assume a 15% growth rate over the next several years. Lastly, we see that the current free cash flow multiple is 13.2. We can bump this up slightly to 15 as a base case. Plugging these values in, we get a price of $110 per share in Q1 of 2026. Even using more conservative estimates, we see that there is still substantial growth for Micron over the next several years when we use a discount cash flow model. Another option is to use the website Alpha Spread to run a DCF model for us. We can see that this maps out our bear, base, and bull case for Micron. We can then alter the exact model used as well as the values for things like revenue, debt, and our discount rate. Discount cash flows are difficult. The math is relatively simple, but making accurate predictions and estimates is almost impossible. Thus, discount cash flows are great to build out multiple cases for a stock, but should not be relied on solely to provide an accurate future stock price. Lastly, we have the book value method. In Graham's eyes, this is the only true way to determine if a stock is undervalued. In order to calculate this, we need to look at the company's balance sheet. Here, we see Micron's balance sheet for Q3 2025. The first value we need is total shareholder equity, which is typically located at the bottom. Total shareholder equity for Micron is $48.63 billion. From this, we need to subtract all soft assets, such as goodwill, trademarks, and other intangible assets. We'll subtract $1.15 billion in goodwill and $423 million in intangible assets from total shareholder equity. This leaves us with $47.06 billion. Lastly, we'll divide this by the total number of diluted shares outstanding, which is 1.118 billion. This gives us a book value per share of $42.09. As you can see, this is far below the current price of Micron. Book value doesn't take a company's brand or anticipated growth rates into account when determining its value. It looks strictly at the assets it carries on its balance sheet and divides those assets among all shareholders. You will rarely find popular companies like Microsoft or Amazon trading at or below their book value. But if you do, they are an incredible bargain. Likely, you'll find unpopular or little-known companies trading around this value. Since they are not well-known, they pose a much higher risk to investors, even at their book value price. Thus, you must employ another principle of Warren Buffett and Ben Graham called the margin of safety. This is the difference between a stock's intrinsic or book value and their share price. If their book value is $100 per share and they're trading at 97, there's not much safety room for this stock. However, if it was trading at $60 a share, this offers the investors roughly 40% margin of safety. If the company is then bought out, the purchaser will at a minimum pay book value for the company, thus still providing the investor with substantial upside. Looking at my portfolio, I bought Micron for an average cost basis of $72 a share. This is under all our valuation estimates with the exception of book value. This provides a 45% margin of safety when compared to Graham's valuation of 130 and a 37% margin of safety compared to the conservative discount cash flow estimates. These margins played a major role in my decision to purchase around $3,000 worth of Micron at $72 a share. The last example I want to show is what an overvalued company looks like. Let's take Palantir. Currently, Palantir is trading with a trailing 12-month PE of over 500. That right there is enough to conclude that this stock is overvalued. But let's look at the numbers. This company is still rapidly growing, so using Graham's method won't give us as accurate data since it only relies on earnings per share, which is 23 cents currently for Palantir. But looking at growth estimates, we see estimates ranging roughly from 50 to 25%. Plugging this into Qualtrim, we get a disappointing picture. Even with a 50% growth rate in earnings over the next 5 to 10 years, Palantir's PE would have to remain over 70 in order to not get below its current price. Both of these metrics are almost impossible to sustain for multiple consecutive years. While Palantir's growth has been strong, it will eventually weaken as the company gets bigger. When this happens, its astronomical PE will be forced to decrease, which will cause a lot of selling pressure and a decreasing stock price. Palantir is an excellent example of an extremely overvalued stock that you should stay away from. Determining the value of a company is difficult. The math and models used to do so are relatively easy, and there are many calculators available online. The difficult part is making accurate assumptions about the business and about its future. There really is only one thing you can do to make your assumptions as accurate as possible. Learn everything you can about the company, from its management team to its business models to its financials and its competition. Truly studying companies provides you all the information you need to make intelligent decisions. Most retail investors hear about a stock and then immediately go buy it. But when you listen to people like Warren Buffett or Charlie Munger, they focus on finding just one quality investment opportunity each year. This allows them to spend adequate time learning all about each potential investment. They then wait for the perfect price before buying. As Warren Buffett said, the stock market is simply a tool used to transfer wealth from the impatient to the patient. So make sure you keep this in mind before you go buy your next stock.